Hello, my name is Jose Garcia, and today we're going to be talking about decoding high frequency markets through numerical methods, specifically noise, volatility, and portfolio optimization. Modern financial markets operate at two conflicting timescales, right? Millisecond order execution speeds versus multi minute fundamental price formation. This tension creates three unique challenges for quantitative analysts or quants: filtering noise from high frequency data, quantifying asymmetric volatility spillovers, and optimizing portfolios under non-normal return distributions. In this study, we address these challenges using a numerical framework that integrates wave-late analysis, dynamic correlation modeling, risk-constrained optimization, and by analyzing 1.5 million data points from Apple stock and Bitcoin trades between 2018 to 2023, we identify actionable patterns and propose robust solutions. So, yeah. Noise, right? So high frequency price data is inherently noisy. Bid-ask bounce introduces 27 to 32 bias points of variance in instruments like SPY, while latency arbitrage creates transient distortions. To recover meaningful signals, we apply a Morley wavelet decomposition with level-dependent thresholding. This approach isolates cyclical components while preserving sharp price movements. The results reveal a persistent 34-minute cycle in equity markets, statistically significant at the 1% level after false discovery rate correction. Surrogate testing confirms the cycle's robustness. Only 0.3% of 1,000 shuffled time series exhibited a stronger spectral power. Practically, this rhythm aligns with the NYSE opening and closing auctions, and suggesting institutional rebalancing drives the pattern. Macroeconomic shocks propagate unevenly across asset classes. During Federal Reserve announcements, we observe crypto to equity volatility spillover intensifying by up to 160% compared to an 80% increase in the reverse direction. Our DCC GARC model quantifies this asymmetry. Post FOMC correlation surge from 0.25 to 0.65, with Bitcoin contributing 32% of equity volatility information share versus 18% pre-announcement. The December 2023 meeting exemplifies this phenomenon. Correlations flipped from negative 0.044 to positive 0.130 during the quarterly futures expiry, necessitating dynamic hedge ratios of about 2.3 to 1 crypto equity notational values. So obviously, you got to be careful. Regime shifts demand adaptive risk management frameworks. Moving on. Non-normal return distributions, evidenced by Bitcoin's kurtosis of 15.7, render traditional portfolio optimization ineffective. We address this via conditional value at risk CVAR constraints paired with Ledois-Wolf covariance shrinkage. The regularization parameter delta equals 0.0112 optimally balances the sample covariance noise against estimator bias. The resulting covariance matrix shows near zero correlation, 0.02, between equities and crypto, enabling diversification despite heavy tails. Backtests from 2019 to 2023 demonstrate the strategy's efficacy. A 1.72 Sharpe ratio outperformed the S&P's 500 at 0.89, with maximum drawdowns reduced by 52%. Transaction costs of 10 bias points per trade were included, yielding 18% annual turnover, a sustainable level of institutional implementation. So as you can see here, comparing cumulative returns highlights the CVAR's portfolio's resistance. During the 2022 Federal Reserve rate hikes, our strategy gained 2.4%, while the S&P 500 lost 1.1%. The outperformance stems from three key factors, which is volatility timing, that contributed 72% of excess returns, covariance structure exploitation 18%, and crypto mean revision 10%. Critically, the portfolio's worst 5% of losses totaled 5.2% versus 23.1% for an equal unweighted benchmark, a 92% reduction in tail risk. This aligns with Rockefeller and Uriasev's theoretical framework demonstrating coherent risk management in practice. So some challenges. So there's three kind of major limitations that warrant some caution. The first is 5-minute equity data misses 72% of order book events due to millisecond level trading activity. Second, Bitcoin returns exhibit structural breaks. Kolmogorov-Smirnov test rejects stationarity. Third, CVAR weights vary 9.7% under alternative shrinkage estimators. However, the Ledois-Wolf method minimizes Kolbach-Leber divergence, suggesting relative stability. Future work, hopefully, because I'm very interested in this, will explore quantum annealing to accelerate optimization and CUDA accelerated wavelets for real-time cycle detection. reducing spectral analysis latency from 2.3 seconds to just a mere 18 milliseconds. So, yeah. To conclude, my findings underscore the value of numerical methods in high-frequency finance. The 34-minute equity cycle, persistent across 83% of trading days, provides a foundation for algorithmic strategies. Asymmetric volatility transmission during FOMC events demands dynamic hedging protocols. Finally, CVAR optimization with regularized covariance enables robust portfolios in non-normal markets. I would advocate for SEC disclosure rules on HFT, cycle alignment, and machine-readable Fed announcements to mitigate asymmetric information. These steps, combined with quantum computing advances, could redefine market efficiency in the algorithmic age. Yeah, that's it for me. So thank you so much. Thank you for a great semester, and I hope you have a good summer, Dr. O.